Welcome to This Week in Finance. I'm glad you're here. This is Market Spotlight, the show where we take one topic, one asset, one story that is moving markets, and we go deep. No fluff, no filler, and just the information you actually need to make smarter decisions with your money. Today we are talking about gold, and I promise you, this is not your typical gold story. We are going to cover where gold has been over the last year, how it hit the most extraordinary price in its history, what happened when war broke out between the United States and Iran, and gold did something almost nobody expected, where prices stand right now as of today, and exactly what ETFs and stocks you should be looking at and what you should be avoiding. Now, this is a full deep dive, so get comfortable and let's get into it. But before we do, a quick and important note. Everything you hear on this channel is for informational and educational purposes only. It is not financial advice. Investing involves real risk and you could lose money. Always do your own research and please consult with a licensed financial professional before making any investment decisions. We do not know your personal financial situation and nothing we say should ever be taken as a personalized recommendation. Now, with that out of the way, let's talk gold. Gold has been used as a store of value for over 5,000 years. Ancient Egypt, Rome, the Byzantine Empire, they all built their economies around it. But in the modern financial world, the pivotal moment came in 1971 when President Nixon ended the gold standard and severed the US dollar's direct link to gold. From that point forward, gold became a freely traded global commodity and one of the most closely watched assets on the planet. Over the decades that followed, gold built a powerful reputation as what Wall Street calls a safe haven asset. The idea is straightforward. When stock markets crash, when currencies weaken, when inflation gets out of control, or when the world starts to feel genuinely unstable, investors move their money into gold because it holds its value when everything else is falling apart. And history backed that up over and over again. During the 2008 financial crisis, gold surged. During the COVID pandemic in 2020, gold climbed to new all-time highs. In every major inflationary cycle, gold was where smart money ran for cover. So heading into 2026, gold was already on one of the most impressive runs in its entire history. And then it went to another level entirely. Let's talk about the numbers because they are genuinely staggering. Driven by persistent global inflation, record levels of central bank buying from countries like China, Russia, and India, a weakening US dollar, and deep and growing concerns about America's long-term fiscal health, gold hit an all-time high of approximately $5,600 per ounce in January 2026. To put that in perspective, gold was sitting around $3,200 per ounce just 12 months earlier. That is a gain of more than 75% in a single year. Institutional money was pouring in, ETF inflows were breaking records. The gold trade had become one of the most crowded and talked about positions in the entire global market. Every major bank on Wall Street was screaming bullish. JP Morgan had a year-end 2026 price target of $6,300 per ounce. Bank of America was at $6,000. Deutsche Bank was at $6,000. BNP Paribas raised their forecast by 27% and flagged a peak above $6,250 as a real possibility. Gold looked, to almost everyone watching, completely unstoppable. And then the war started and everything got very strange. In late February 2026, military conflict broke out between the United States and Iran. And what happened next in the gold market is one of the most counterintuitive things we have seen in years. Every traditional playbook, every historical pattern, every analyst model said the same thing. War in the Middle East means gold goes up. Geopolitical chaos is exactly the kind of environment gold was built for. That is the whole point of the safe haven story. Instead, gold fell hard. From that January peak near $5,600, gold dropped more than 10% through March, its worst monthly performance since June 2013. The Iran conflict did not send investors rushing into gold, it sent them rushing into cash. And understanding why that happened is actually the most important thing you can take away from this video, because it tells you a lot about how gold really works. There were three forces working against gold simultaneously. The first was the oil shock. When the conflict led to the closure of the Strait of Hormuz, a waterway that carries roughly 20% of the world's global oil supply, Brent crude exploded past $100 per barrel. That created a massive new wave of inflation. And here's the part that tripped up a lot of investors. When inflation is being driven by an energy supply shock like this, the Federal Reserve cannot cut rates to help the economy. Their hands are tied. Rate cut expectations for 2026 collapsed almost overnight, going from 3 or 4 expected cuts all the way down to potentially 0. And when rates are expected to stay high, Gold, which pays you absolutely nothing to hold it, becomes a lot less attractive compared to bonds or even cash. The second force was pure profit taking. Gold had just posted a 75% gain in 12 months. That trade was absolutely packed with investors sitting on massive profits, and a lot of them were doing so with leverage. When a shock event hits and uncertainty spikes, those leveraged positions get unwound fast. The SPDR Gold Shares ETF, GLD, saw billions of dollars in outflows in a very short window. That kind of selling pressure can overwhelm safe haven buying even when the fundamental case for gold remains completely intact. The third force was a stronger dollar. As global uncertainty spiked, capital flooded into U.S. Treasuries and the dollar itself. The dollar strengthened significantly, and gold has a well-established inverse relationship with the dollar. When the dollar goes up, gold tends to go down. All three of these forces hit at the same time, and the result was a gold sell-off that shocked a lot of people who thought they understood the asset. So where does that leave us today? As of late April 2026, gold is trading around $4,600 per ounce. So that is down roughly 18% from the January all-time high. The Iran conflict is still ongoing, peace negotiations have stalled, the Strait of Hormuz remains a point of tension, and the Fed is right now in the middle of a two-day policy meeting. Markets are pricing in virtually zero chance of a rate cut, with the federal funds rate expected to hold at 3.5 to 3.75%. Jerome Powell's press conference following the meeting will be watched very closely by gold investors for any hint that rate cuts could be back on the table later in the year. Here's the number that should really get your attention, though. A Reuters poll of 31 institutional analysts and traders published just this week raised their median full-year 2026 gold price forecast to $4,916 per ounce. That is the highest full-year consensus in the history of that survey, which goes back to 2012. And they raised their targets even while gold was selling off. That is not a small thing. That tells you that the professional money is not running away from gold. They are treating this pullback as a positioning opportunity, not a structural breakdown. Today's price of around $4,600 sits about 6% below that professional median forecast. The structural drivers that pushed gold to $5,600 in the first place, central bank diversification away from the US dollar, long-term fiscal sustainability concerns, and the slow but steady de-dollarization trend as more countries settle trade outside the dollar, none of that has gone away. The rate environment is the headwind, and rate environments change. Now let's talk about what you can actually do with this information. We are going to break this down by risk tolerance from conservative to aggressive. If you want clean, simple gold exposure without taking on any extra complexity or risk, the two best options are the SPDR Gold Shares ETF, ticker GLD, and the iShares Gold Trust, ticker IAU. GLD is the largest and most liquid gold ETF in the world with over $176 billion in assets under management. It holds physical gold bullion and has an expense ratio of 0.42%. IAU does essentially the same thing at a lower cost with an expense ratio of 0.25% and over $80 billion in assets. For investors who plan to hold for the long term, that cost difference adds up. There is also SPDR Gold Mini Shares, ticker GLDM, which offers the same physical gold exposure at an expense ratio of just 10%. That is an excellent option for retail investors who are building a position gradually over time. For investors who want more upside potential and are comfortable with more volatility, gold mining ETFs are worth a serious look. Mining companies carry what analysts call operating leverage. When gold prices rise, miners' revenues go up while their fixed costs stay relatively flat, so their profit margins expand faster than the metal itself. That dynamic drove the VanEck Gold Miners ETF, ticker GDX, to gains of over 100% in the past year, while physical gold itself gained around 50%. GDX holds the world's biggest miners, including Newmont and Barrick, with $30 billion in assets and a low 0.51% expense ratio. For investors who believe gold is heading back toward $5,000 and beyond, GDX is one of the most straightforward ways to express that conviction. If you want even more upside and can stomach more risk, the VanEck Junior Gold Miners ETF, ticker GDXJ, focuses on smaller and earlier stage mining companies. Higher volatility, but significantly more upside potential when gold is in a bull run. On the individual stock side, analysts are currently pointing to AngloGold Ashanti, ticker AU, and Franco-Nevada, ticker FNV, as two of the highest conviction names in the space. Franco-Nevada in particular is interesting because it operates as a royalty and streaming company, meaning it collects a percentage of mining revenues without taking on the direct operational risks of running a mine. It tends to behave like a lower volatility version of a mining stock, which makes it a good complement to a position in GDX or GDXJ. What you want to avoid right now: the leveraged inverse ETFs, specifically DUST and JDST. Both are showing death cross patterns on their technical charts, and they are strictly for short-term traders, not buy and hold investors. So let's bring it all together. The structural bull case for gold is not broken. Central banks around the world have been accumulating gold at near record levels for 3 straight years and have not reversed course despite the recent price drop. The long-term concerns about US debt, dollar credibility, and global de-dollarization continue to build in the background. The near-term pressure is coming from the rate environment created by the oil shock from the Iran conflict, and that is a temporary condition. If the Fed signals even a modest shift toward easing later in 2026, the setup for gold could become very powerful very quickly. JP Morgan's $6,300 year-end target implies more than 35% upside from where gold sits today. Whether this is the buying opportunity of the decade is something only you can decide based on your own situation, your risk tolerance, and your research. But the professional consensus is pointing in a very clear direction. That is going to do it for today's Market Spotlight. We went deep on gold, the history, the record run, the Iran conflict sell-off, the current landscape, and the plays that analysts are watching right now. I hope you found real value in this one. If you did, please do us a favor and hit that like button. It genuinely helps more people find this channel. And if you are not subscribed yet, now is a great time to do that and hit the notification bell so you never miss an episode. We drop new content every week, including our Saturday weekly wrap-up, Monday stock picks, and the Wednesday market pulse for your midweek check-in. As always, do your own research, protect your capital, and we will see you in the next one.